Big banks are kicking off the first quarter earnings season, and we want to talk about the ways that you can incorporate the financial sector into your portfolio. Here with more, we've got Suryansh Sharma, who is the Morningstar Senior Equity Analyst. Great to have you here with us. So let's just start with the state of banks right now. As the markets see lots of volatility around President Trump's tariff policies, how will that flow through to what we hear from the banks?
For sure. Thanks for having me. I think the tariffs, when they were initially announced, they were substantially more aggressive than what the market anticipated. And I thought what surprised the market the most was just the breadth and the scope of tariffs. So every good was targeted, every country was targeted. And I think it's widely expected that if these tariffs, we have a 90-day pause, but the uncertainty is not over. So if these sort of tariffs go into place, it's not going to be good for the US economy. And banks are tied at the hip with US economy's macroeconomic performance. So if the economy is not doing well, the banks will definitely not do well.
What are the key areas for investors who are trying to track the banks and their metrics over the course of this earnings season that you're going to be watching for?
For sure. The most important thing is what happens with tariffs. And I think if tariffs go in place, the profitability of banks would be hit across the board. So the first thing is if we see macroeconomic weakness, Fed may cut rates faster than expected. If Fed cuts rates faster than expected, a lot of banks in our coverage are asset sensitive and their net interest margins can contract, which means that their NII could head downwards. Also, I think given the very high uncertainty that we see, loan growth can take a backseat because companies would really hesitate to do deals or expand a lot. I think after the election, there was an expectation that we are going to see an M&A boom or an investment banking boom. It seems like we're going to get an investment banking bust. So investment banking revenues are inherently cyclical. They may take a hit. We've seen capital markets correct. So if capital markets correct, not good for asset and wealth management revenues. And then finally, I think one of the biggest areas to keep in mind is what happens with provisions. So if banking as a business is just banking cycles can be very large. So let's say the banking cycle is 15 years on average. We can have 14 out of those 15 years where the provisions are less than average. And then during a recession, the provisions can just spike a lot. And I think that's what the market is worried about. And I think that's what I'm really looking forward to hearing from bank CEOs in the upcoming earnings season.
Well, we've already heard from some of those bank CEOs right ahead of the earnings, of course, as the largest U.S. bank CEO and chair, Jamie Dimon, is coming out talking about his own concerns about a recession related to some of the tariff policy that had been rolled out. So which of the banks is best positioned and which one do you think is the top pick that investors should be considering?
For sure. Just giving some context on valuation. So even before the tariff uncertainty, I think we were one of the lowest on the street with respect to our fair value estimates. For banks, we thought that, the bank valuations were already strong. The banks were out earning in certain parts of their businesses. JP Morgan was doing a 20% return on equity with very high capital levels. This is just, extremely strong profitability. And the markets were just extrapolating it. So we were already sort of on the lower side. We think that currently the sector is undervalued, but only slightly undervalued. So I think what we are recommending clients is to be very selective in going within the bank sector. The names that we like are Bank of America in large money center banks, which is around 20% undervalued to our fair value estimate. We also like US Bancorp, which is a Whitemore rated name and around 30% undervalued, has very strong free franchise. And I think those are two names that we like in the current environment.
Suryansh, thanks so much for taking the time here with us today. We're going to be checking back in over the course of earnings. Appreciate it.
Thank you.